Okay. All right. So welcome everyone. Apologize for a little bit of confusion on the link today. Our host, Peggy Beauregard, is traveling right now, and I wasn't able to get into her Zoom account. So I had to actually create a separate login, and I'm hoping many of you will find the link today. Today we have Ethan Gow on as our special guest, and Ethan has owned several rental properties, made over 400 private loans secured by real estate, both in single family and commercial real estate. He's invested in over 100 single family fix and flip projects and is the general partner on multiple commercial and multifamily projects totaling over 1,700 units. His primary role on deals is loan guarantor or key principal, completion guarantor, or gap funder. Now, where the sponsorship team, in essence, has raised around 70% of the limited partnership equity, but does not have enough time to raise the remainder. So Ethan will come in and lend that remainder to the team so that the deal can get it done on time. Now, Ethan has invested in things like hotels, self-storage, office building, medical office, and retail, in addition to the single family and multifamily opportunities mentioned a moment ago. Ethan graduated from Cornell University with a BA in economics in 2003 at age 19, and from Columbia Law School in 2006 at age 22. So he's a pretty smart guy. So with that, I'm going to turn it over to Ethan and have him talk to you more about gap funding and also key principal. Thank you, Ethan, for being on the show.
Thank you, guys. Today's session won't be super long. Actually, I budgeted only about half an hour, and looks like we're going to have a limited audience anyways due to various technology issues. So I'll just walk through being a loan guarantor first. So for folks that aren't familiar with that, the way that generally commercial loans work in syndication and multifamily in particular is that the lender requires that the lead sponsorship team has net worth that exceeds the loan amount. So let's just walk through an example. Let's say we were buying 150 units in Phoenix, Arizona. We might be paying 25 million for that. We might be borrowing 15 million from a lender, and we will probably be raising 10 million from our limited partners, friends, family, associates, people we just met. In that case, if the lead sponsorship team doesn't have net worth that exceeds the 15 million loan amount, they would have to bring on an additional person or multiple people to help them meet that net worth requirement. So the lenders don't just usually take your word for your net worth. They do another compliance check, which is show me 10% of that liquid, or show me 1 year in reserves liquid, something like that. So in our example, let's say we did meet the net worth requirement, but we're very gung-ho real estate investors. We're not going to have a lot of cash because we're going to invest all of our money into real estate. So we might not have the 1.5 million of liquidity that we need to show in order to get the deal approved. And in that case, we would have to bring on another person or multiple people to help us fulfill that compliance check. And then lastly, lenders typically also require that the sponsorship team have collective experience that's acceptable. So usually that means, show us a couple of deals you've done. Maybe you haven't exited them, but at least you've successfully purchased them and potentially you've successfully rehabbed them. So that's what being a loan guarantor is about. It's adding additional balance sheet, specifically liquidity and net worth to a team so that the team can fulfill the various requirements in order to get the loan. A variation of this is a completion guarantor. Some new development deals, the lenders, they don't necessarily need you to sign on the loan. What they want is they want someone that they can sue and take money from if the project is not complete at a certain period of time. So there have been deals where I get brought on just to sign that one particular piece of legal document. And in many times it's separate from the loan guarantor role. It's just a separate role where the lender just needs someone that has liquidity that they feel comfortable that they can take money from if the project is not complete. And then once the project's complete, my role as a completion guarantor is literally over. I don't have to do anything else. So I just need them to make it to completion, and then I'm completely gone. My risk is completely gone. So that's kind of what that's about. And then there's kind of like a, opposite side of the coin, another business that I have that takes advantage of my liquidity is I'll make gap loans to investors. So on that same deal I talked about in Phoenix, let's just say we needed to raise $10 million of limited partnership money. Let's say we only raised 7 or 8 million. We really like the deal. We don't want to lose it. We don't, we can't get an extension. We don't want to return 8 million, 7 million to our investors. We don't want to look, like we're really incompetent to the brokers, et cetera, et cetera. It might make sense to borrow this $2 to $3 million from someone just so we can close the deal and then we can repay this loan after closing. Whether that's from post-closing fundraising or from, sales of other assets or what have you, for, whatever the case may be. So that's the deal that I've done multiple times. I've done variations of that where I just kind of come in at the last second, help somebody get their deal over the finish line, and then they figure out how to pay me back post-closing. And that's a situation that I specifically look for to invest in. So that's kind of my high-level presentation about being a loan guarantor and being a completion guarantor, as well as being a gap funder.
So you're ready for questions?
Yes, I'm ready for questions.
Right. So, and when you want to ask a question, feel free to raise your hand, and we'll call on you. But in the meantime, what is exchanged? So when you go in as a general principal or key principal, what are you looking at for exchange of you going into the opportunity?
Yeah, great question. So I'm looking to be paid in some way. I'm not doing it for free. So typically people give me a general partnership slot in their team with a specific percentage for the deal. Sometimes if they really like the deal, they might only want to pay a cash fee at closing, or part cash fee at closing, part equity. So it's kind of specifically negotiable, but in general, it would be paid in a combination of cash or general partnership equity interests.
Okay. Looks like Clarence has a question. So Clarence, unmute yourself and ask your question, please.
Thank you. I am unmuted, and thank you, Ethan. I think that Ethan just hit on the question I was going to ask, and that was what he charges for either a loan being a loan guarantor, completion guarantor, or gap loans. Can you elaborate a little more on that, Ethan? Do you charge like a certain amount, or
yes,
or do you expect a certain amount?
Yeah, so everything's kind of specifically negotiated. Generally, especially if you come from a coaching tree or a specific team, let's say Brad Sumrock or Michael Blanc, you might see certain allocations already suggested for you. So typically, if somebody comes from one of those coaching programs, I'll just generally take what the coaching program recommends. That they'll allocate out what capital raising is worth, what finding the deal is worth, what earnest money is worth, what asset management is worth, et cetera, et cetera. So that's without giving like literally the actual percentage. I think that's the closest I should be saying in a public forum.
And who'd you say the coaching tree? Michael Blanc?
There's a bunch of them. There's Brad Sumrock, Michael Blanc, Tyler Devereaux. It's all the people that run coaching programs. They usually suggest an allocation for deals.
And they're running these coaching programs for syndicators?
Primarily, yes. I mean, they'll take your money regardless of what you do.
Well, I'm sure. I've never had a coaching program, so I haven't a clue.
Yeah, me neither. So once I started in this industry and I saw a lot of people come from these specific coaching trees, then I kind of noticed the pattern, and I saw in their underwriting spreadsheets how they allocate points for doing what. So generally, if somebody comes from one of those systems, I'm generally just fine following whatever comes from that program.
And shall I assume that you have funded some of those people then?
Absolutely.
So apparently their coaching programs are being successful.
I don't That's hard
Okay.
to say. I mean, that's always hard to say, right? If somebody
Right.
somebody gets into Harvard and graduates and becomes super successful, was it Harvard that really made them successful, or was it the fact that they were able to get into Harvard what made them successful? So it's hard to disaggregate.
Well, my point is that you're seeing an adequate quality in what they're bringing to you to take a position.
Yes,
Okay.
but that's not true for all students. It's just, I mean, there's hundreds of, thousands of people that go through these programs.
Sure, and I'm sure you probably only get involved with a small percentage of the presentations you receive.
Correct.
Okay. Do you, if you're a completion guarantor, you must be very happy with the project, all components of it. I would presume.
I'm
That-
generally happy with the general contractor, and I'm happy with the overall plan.
Okay, and if you're a loan guarantor, then you must be comfortable with an equity cushion behind the loan you're guaranteeing.
Correct. I mean, the equity's already there. I mean, there's no legitimate lender will give 100% financing.
Right, right.
So being a
And-
loan guarantor is really about picking the right partners.
Correct.
So if, the way it works is essentially you can commit unlimited fraud on a project if you want. And if you have $1 more than the loan amount to be paid, lender doesn't particularly care.
Right.
You could be Jesus Christ and be the best person in the entire history of the world. If you're $1 short of the loan, the lender may care.
Got it. And just to push a little bit more on when you take a general partnership slot. Well, forget the percentage that you're going to get. I mean, I would imagine that if you are providing gap loans, a gap loan, you're looking for a minimum return on that, either in the way of points and interest or fees or whatever. Can you share what your minimum threshold is to make it worthwhile to you?
For a gap loan, generally I prefer loans over $1 million.
Okay.
And then I prefer maturity dates that are 4 months or under.
Okay, and if you're making that gap loan of $1 million, 4 months or under, what fee do you anticipate to catch your interest?
Yeah, I can't say that in a public forum, but the answer is extremely high. It's meant to be a premium product for a special situation, a get out of jail situation. So it's charged accordingly.
Okay. Thank you.
Any other questions from the crowd?
Doug? Looks like Doug's got his hand up.
Hey, yeah. So, my question was primarily to understand the difference between a hard money lender and a guarantor in the commercial sense. I'm assuming there's going to be I'll just leave it at that. What would primarily be the difference between the guarantor and a hard money lender?
We're basically talking about chicken and egg and bird and cow. They're not at all the same. Hard money lender is somebody that'll lend you money on a project. They secure their loan with assets, primarily the project. So they'll take a first lien deed of trust against your project. A loan guarantor is just somebody that signs on a loan so that you get approved for it. Loan guarantor is someone you need to bring in because you're not strong enough to get it yourself.
Okay. So you're basically like a co-signer in that regard.
Yes, that's exactly what it is.
Okay, I got you. That makes sense. And then what was the other role that you said you were playing?
Gap lender. So this is a situation, let's say you're buying a $25 million apartment building in Phoenix. You're going to borrow $15 million from Freddie Mac and you need to raise $10 million from your friends and family. Let's say you've only raised 7 out of the 10 million. You can't get an extension on the contract. Everything's ready. Title's ready. surveys ready, appraisals ready, lenders ready to rock. Everybody's ready to rock. You're just missing $3 million. What do you do? Instead of panicking and losing your deal, you can call me and I'll lend you $3 million so you can close your deal.
Okay, so maybe that was the analogy that made me think about a hard money lender.
Yeah, it's completely different. So a hard money lender typically almost always requires a first lien deed of trust. The gap loan, that's impossible to do. There's already a Freddie Mac lender. It's impossible to replace them.
Gotcha. So then how do you protect yourself since there's no property for you to place a lien against?
Generally, I try to pick good counterparties. So I try to pick people that aren't going to try to not pay me back. And then what I do is I take collateral in other projects that aren't I take completely different collateral than the actual project being funded.
Okay. Okay. Gotcha. Interesting. All right. Appreciate it.
Thanks for the questions.
Clarence. You're muted, Clarence.
Sorry.
Got it.
Ethan, do you use your own private or family or partner money? Well, I shouldn't use the word partner. Or do you have a fund for this? Do you raise money for this, for your gap loans?
So whenever I make a commitment to fund a loan, it's either money that I have or money that I control. So I would never walk into a situation and tell somebody, yeah, I got you $3 million in Phoenix. Don't worry about it, unless I already had the money or I controlled the money. So the answer to your question, it's primarily my own personal funds. And then I also am a co-manager of a private equity firm. And one of our strategies is to do this business, but it's not the primary focus of our private equity firm.
Okay, thank you.
Any other questions right now? Oh, wait. I see you're still talking. Go ahead and unmute, Clarence. I thought you were finished.
That was my fault. In the situation that you mentioned where you would use, where you're a gap funder and you use other collateral, do you ever go in second position behind the Freddie Mae or Fannie Mae or Freddie Mac or Fannie Mae loan, or is that prohibited?
That's generally going to be prohibited.
Okay, thank you.
Well, while we're waiting for someone else to ask a question, and this might not be an appropriate question, Ethan, let me know, but are there any similarities for what you do in some circumstances that are similar to a venture capitalist, or is this very different? Or what would be the similarities if there are any?
There's no real
similarity at all.
No, I mean, venture capitalists are investing in something that's more of an idea without cash flow and without stabilization. What we're doing is we're buying, unless it's a ground up development or something. We're not, this is even remotely close to venture capital.
Okay.
This is a special, if you want to classify it, this is a special situations loan. That's what it is.
Okay. And are there opportunities outside of real estate or multifamily where your services would be beneficial for someone? And if there would be, what would that be?
Yeah, that's a phenomenal question. So I'm constantly asking myself that question. So essentially the business that we're in is short-term loans where it makes sense for somebody to pay us a stupidly higher interest rate. So we can find those situations kind of like I described, where somebody is short on fundraising and what they have to lose is a lot. So it doesn't really make sense for them to lose a deal and lose a lot of money when they could lose or they can pay me a smaller amount of money, but still stupidly high to get their deal done. So where else would this situation take place? So number one, I'll ask the crowd, if you guys can figure out a place where this would take place often, please let me know. I would love to go fishing in that specific pond. A few other scenarios I've seen. One was a deal where somebody wanted to buy a coal mine in West Virginia, and they wanted to borrow money to do a lot of pre-closing due diligence. surveys, appraisals, and the like before they closed. So I looked heavily into that situation and concluded that it didn't make enough sense. So I didn't do that. This also happens in non-real estate related things. Let's say you're, a wealthy individual that owns a boat or a plane or a nice car, like a super fancy collector car or, a piece of art. You might yourself be in a situation where you have to do something, pay your taxes, pay your ex-spouse, pay your business partner, who knows what, but it makes sense to you. And you might need the money really fast. And you might want to essentially borrow against your boat, your plane, your artwork, or your collectible car. And that's where I would also be interested in lending in those situations.
Thank you. Doug?
Yeah, so I guess my next question was going to be, is there a role for those of us on the telephone who would, maybe be interested in participating in an opportunity like this? Are there times in which, hey, you're there to provide gap funding, but hey, they need an extra $100,000, and so hey, I can partner with Doug to get that extra $100,000? Or is it strictly, hey, this is just educational of what it is that you do, but there's not really an opportunity for any of us to partner with you or to participate in opportunities like this?
Yeah, so the short answer is no, there's no real specific opportunity to partner with me on this. You could invest in the PE fund that I manage, and a portion of that would do this business, but not all of it. This is more just for educational. And then, what I'm hoping is you guys might run into situations where somebody needs a gap loan, and then you'll think of me. Or somebody might need a loan guarantor. They don't have enough liquidity or net worth to sign on the loan, and you'll remember, hey, I listened to this guy talk on Tuesday.
Doug, any other questions?
No, that was all. I was just trying to see if he was here for me or if he was here for himself.
All right, let's go to Clarence.
Doug, do you have to, or Ethan, do you have to concern yourself with usury?
I do. I have to concern myself very much with usury laws.
Okay, and it's probably state by state?
It is state by state, correct.
Okay. And you're not shielded by the fact that it's a commercial borrower?
That doesn't always solve the issue.
Okay. And last question, are you going to share, well, maybe not the last question. Are you going to share the name of your private equity firm with us before you leave today?
Sure. It's called Good Bull Investments.
Good Bull?
Yeah, Good Bull Investments. If you just look me up on LinkedIn, you'll see it.
Okay. Thank you.
Anything else, Clarence?
No, thank you very much, Ethan. And
No, thank you. No, thank you for engaging. These are great questions, guys.
Thank you.
All right, Macrellis, I imagine that's Lisa.
Yes, it's me. I'm new
Hi,
at
me.
this, so
Go
hello.
for it.
Yeah, I just wanted to check. You said, Ethan, this is really interesting. You do the loan guarantor or gap lender. Is there what do you consider a short term? Like how many months? And then is there a minimum amount or a maximum amount that you only go through that, which is I guess attractive for you to go into? Am I making sense?
You are, but I think you're conflating two things. So being a loan guarantor,
Okay.
it just means I sign on a loan for you.
Okay.
So we're on that loan until you pay it off, whether you pay it off from selling the property or until you refinance. Like we can't go to the lender and say, oh yeah, 6 months has gone by, hey, we don't have a loan anymore. That's not how loans work. So that's a loan guarantor. I'm just helping you get approved for a loan.
For the loan.
We still have to keep that loan for the time. Being me lending money to a deal, I generally prefer larger deals. We add more value on larger deals and there's just more money at play. So the
Okay.
biggest deal I've done is $6 million. We did that same day. I got a call at 9 a.m. We wired 6 million at 3 p.m. We got paid back every penny within 88 days. So I would love
Oh,
to
wow.
do deals like that. I don't want to do
Okay.
them same day. I'd rather have about a week if we can.
Okay. Thank you.
So if anyone has no questions right now, I'd like to ask you, Ethan, tell us how you got started in this, and you know, what did you do to do this? I mean, this is not something a lot of people are familiar with, and I find it very fascinating. So can you share with us a little bit about how you got started in this direction and what you did with this?
Sure. So I started my career as a corporate attorney doing a lot of mergers and acquisitions on Wall Street. So we were usually doing deals that were in the billions of dollars. The paperwork is generally the same if it's a billion or, you know, a couple hundred million. It's not like it's that different. There's just a little bit more at risk, more on the line, more, you know, just more intense. So I didn't really want to continue in that world. And so I kept on trying to find a way to not have to work in that industry. So I discovered real estate, and then I read a bunch of articles and listened to a bunch of podcasts. And I determined that being a hard money lender was a good way of making money, because I already knew how to do loan documents from my legal job.
Oh, that's really cool. So reading articles and listening to podcasts, and you're working with doing what you're doing now, that's pretty impressive. But I imagine there was a certain degree or a certain ingredient that you brought to it to make it all come together and work.
Correct.
I think your video is blurring just a bit.
Oh, sorry. Yes. The answer is, I think the answer to your question is yes. Sorry, my computer's not going great here.
That's all right. What was the unique aspect that you brought to this to make it all work?
Having money.
Having money. Okay. And then once you had the money, was there any type of vehicle that you moved into so that it would grow so you could actually do more of what you're doing? Or was it just sitting in a savings account or a series of savings accounts?
Yeah, unfortunately, there's no magic machine where you can put the money in and then just a bunch more comes out. That's hard. I do love life insurance policies, so I put as much of my money into life insurance policies as I possibly can. I've owned life insurance policies for over 9 years, and I liked them so much that I became a licensed life insurance salesman about 7 years ago.
Very nice. And I was kind of thinking that might be what you've done. And it seems like a lot of the successful, wealthy people find that a cash value life insurance policy is a great vehicle for housing and growing wealth while you're deploying it into other investments at the same time.
Correct.
Very nice. Clarence, you've got your hand raised.
I do, and I'm glad I didn't say the last question was my last, because I have 3 more.
Oh, well, please. I'm so glad you're here today.
But they're sort of succinct. The first question, Ethan, is what state are you in?
Texas.
Okay. The second question, you mentioned you like life insurance policies. Does that mean you like investing in life insurance policies on other individuals?
No, I don't like that business at all. I've looked into that business multiple times.
Okay. Okay. So you just like life insurance policies for yourself.
Correct.
Okay. And that's because you love your loved ones so much. Is that
Yes.
correct? Okay.
Yes, because a life insurance policy is like that magical machine that Cliff talked about, except it's just not that fast.
Yes. What did you call that, Cliff or Ethan? What that particular life insurance policy? What's that called?
Cash value. You can call it cash value life insurance. You can call it permanent life insurance.
Is it
Infinite
like
Infinite banking, velocity banking, those are the other
Okay.
terms.
Yeah, we're really
Okay.
not supposed. Yeah, as a licensed insurance agent, I'm not supposed to say the other terms because it's too gimmicky.
Oh, I'm sorry.
That's okay.
Okay.
No,
But-
you can say it all day long. I'm just not supposed to
No,
say it.
I have a license too. I just didn't know that.
Yeah,
I
no,
couldn't say
there's some memos going around life
Oh,
insurance
okay.
companies telling people stop calling it that.
it. Okay.
okay.
I didn't get that
Um,
memo.
Okay, no problem.
And then the third question for this round is, how does what you do relate to being a transactional funder?
Transactional funding is pretty specific. Transactional funding is usually used for double closes where someone is, buying a property and then immediately selling it. And, if they have to close on it themselves for a legal or compliance reason, then they have to actually put up the money to close the deal. Usually title companies don't require that, but the ones that do, I would love them to call me because I will do that loan every day. I don't even need to know what the property is. I don't even need to know who the borrower is. All I need to do is wire in the money and then I get it back the next day.
And you
Risk.
feel that you feel that secure with it? Do you have
Yes.
to be involved with escrow, title insurance, all that stuff?
Yes. I mean, I have to make sure it's a legitimate title company. They understand the steps of the transaction, so they don't do the ordering wrong.
Will you get a lender's policy of title insurance to protect your money?
So it depends on the state. That's not necessary in Texas. So the title insurance is actually not issued on the first leg of the transaction.
How about for your own security?
No, I don't need it because it's a riskless transaction. My money is not released from escrow until the second leg of the transaction is released. So there's unless there's a fraud or there's a really stupid escrow officer, there's really no risk.
Okay.
There's so little risk that, like I said, I don't even need to know where the property is. I don't even need to know the address, and I don't even need to know who the borrower is.
Can you share what you charge for that service?
Usually we can only charge a point or two for that.
Okay. Yeah.
We're not, but because it's risk, basically no risk, and it's really fast. It's
Like 300% a year.
Yeah, it's not like we can charge that much more. I mean, I wish I could, I would, but I can't.
Well, you'd probably be happy just to do that every day.
Or even twice a week, I'd be happy.
Yeah. Okay.
And so
Well,
is that not something that the rest of us could take advantage of as well?
You'd have to go generate the deal flow though.
Right.
So I had somebody in my office, and then I have to go. Sorry, everybody. I had somebody in my office. I just said, hey, call every title company in this state because they do require double closes. So I'm waiting to get a list of the ones she called and see if they need a transactional funder. If they do, I'll do them all day long.
Thank you.
So if you guys want to do that and just find title companies that require that and they require the money to be wired in and they'll wire it out same day or next day, let me know. I'm happy to partner with you on that.
All right. Well, we'll write that down, I'm sure.
All right, everybody. I got to run. This was really great talking to everybody. Thanks for the great questions.
Thank you so much, Ethan. I appreciate you joining us today on the Nest Egg Builder
Thank you,
Show.
Ethan.
And we'll be back next week, same time, and new channel.
Thank you so much.
Thanks,
Yes,
Ethan.
thank you.